On this episode of Through the Pines, we'll cover the questions financial advisors love versus hate, including questions like, what are the biggest risks to my retirement plan? And what return can I expect from this? How should I be thinking about taxes over my lifetime? Should I put money into gold or crypto? What decisions today will matter 10 to 15 years from now? My friend did this. Should I do the same? How will our strategy change once I retire? Should I move everything into cash until things calm down? How do we define success if it's not just in investment returns? And is now a good time to invest? Oh, these are such good questions, but are they good or are they bad for financial advisors? What do they love? What do they hate? Welcome to a financial planning podcast with a down-to-earth vibe. Sasquatch listens while prepping his annual tax returns. This is Through the Pines. Our advisors for this episode, we welcome back Rex Baxter and Brandon Smith from planwithbaxter.com. That is planwithbaxter.com. If you want to get a hold of them, go to planwithbaxter.com. 2023, 24, and 25. Forbes Best in State Wealth Management Teams for Utah. Advisor Hub's fastest growing advisors to watch over $1 billion. Under $1 billion, and the receivers of the Ameriprise Client Experience Award. When do you find out about the 2026 Best in State?
Oh, Rex? Big news. Big news.
What? No.
Yeah. We were just received the 2026 nod.
26 just started, so they do this like a year before?
So you apply in 25 for 26, yeah.
So I got to adjust my notes.
Yeah, so that's cool. Adjust the notes. Wow. We're now in 2023, 24, 25.
Congratulations.
26.
Yes.
There you go.
4 years straight, best in state wealth management teams for youth. Congratulations. That's
hey,
a
thanks.
Big deal.
That's
I have
a big
a.
Deal.
Nope, not that one.
Hey.
There it is.
Oh, I'll take them all. I'll take them all. Take them all.
All right, so let's dive into these questions. Do you love them or do you hate them? Beginning with the first one. What are the biggest risks to my retirement plan, Brandon?
Thanks for having us on. Love that question. Really love that question.
Okay.
And the reason why is when you're going through a financial plan with people, I mean, the first and like the biggest thing everyone wants to know is like, all right, when can I retire? How much can I retire on? What does that feel like relative
Time out.
to what
I'm already butting in, and this is because I find that fascinating that is the question everyone asks.
How is that? What? No, that's like the most likely outcome, what you really want to know. Like people literally, like I'll meet with people
I know.
And they're nervous, right?
I
Like
know.
literally nervous because they're like, man, how much longer can I work? I
Sure.
need to be done. I have these dreams. I want to go travel. I want to spend time with grandkids. I want to do all these things, but they're not sure if they can.
I just
right?
feel like that's the wrong way to live.
What do you mean?
This is not the podcast for this, but Rex, this is the wrong.
Bring it out. Just bring it out.
Because you have to be able to adjust financials so that you can live while you're alive and not wait to this end date of retirement.
Totally agree.
And
Couldn't
so
agree more.
That question of when can I retire is more of like, when can I be financially independent so that I can, or how can, but I feel like it's the wrong question.
But they should reframe it, right?
Yes.
I agree. You should reframe the question. And a lot of times we do this when we're meeting with clients is not necessarily when can I retire, but it's when do I have the flexibility to not have to work anymore or to choose how and where and why I'm working.
Okay.
And so typically we'll reframe that to that kind of position, and we'll look at it and we'll say, hey, look, by the time you're 58 or 62 or whatever that age is, at that point you have enough to where the power is now in your court to make that decision, and you can decide, do I want to continue doing what I'm doing, whether you're burned out or you love it, or do I want to go and pursue a different passion, or do I want to be done and go travel, or you've got that flexibility. And so I think reframing that question is critical and important, but I think that is the most common question we get is can I retire and when can I retire?
Yeah, and Brandon, and you love it, and that's because you have a good answer for it.
Right, but the original question is, what are the biggest risks to my retirement plan? Right, everyone wants to know, like, when can I retire? That as is been nicely demonstrated by all of us here, right? Like that is the big question that everyone asks. Rarely do people ask, like, well, what happens if I start retirement and then I see a recession right out of the gate? Or what happens if like I start retirement and then one of us passes prematurely? Or what happens if I go into a care facility? Or what, all of these questions that are very relevant questions and all questions that should be explored. Those are less flashy and it's kind of nobody thinks it's going to happen to them type thing, but yet they're still important to plan for. And so it's I love when I get those questions. Like, what are the risks do I have? And obviously I try and go through those either way, right? Whether they ask or not. But it sure is fun when you get that engagement beforehand. Like, hey, I want to know.
And speaking of risks, that might be something, Rex, you may have seen this. That might just be something that we don't know what the risks are until we're told what they are. Like,
yeah, I think there's a lot of risk that it goes back to the old saying, you don't know what you don't know,
Yeah,
right?
you don't-
And
right.
and a lot of times it's not that you don't know it, it's just that you haven't sat down and really thought through the issues thoroughly.
Yeah.
And again, from a young age, you feel like you're Superman and you're invincible, and it may happen to your neighbor, it may have happened to your parents, it may have happened to a sibling, but it's not going to happen to you. Right. And the market certainly wouldn't dare crash the day after I retire. And
Never.
so, I mean, so I think when people do sit down and they actually think through it, but I also that they'll come up with the right questions and we can help them with the right answers. But I also think that makes them very vulnerable. And I think that people are scared to be vulnerable when they first come into a financial advisor. I think that they feel like they need to have the answers, that they need to be confident, and they need to make sure that they're coming across in some way to us, which is not right. They really just need to come in, open up, and we'll pull the questions out of you. We'll find those answers. But the more vulnerable you are, the more open you are, the easier it is for us to get to the right questions, the right answers, and figure out where things are at.
Okay.
Yeah, one last piece on that is that as is true with most things in life, the risk feels and looks a lot worse than it usually is. And that's certainly true with most of retirement planning. People come in are so nervous about Social Security being there, right? People are so nervous about inflation. People are so nervous about market downturns. And those all have answers, right? And we don't have a perfect vision of what's going to happen, but we definitely have backup plans. And so, voicing those concerns about risks, usually we can work through those. And those are fun meetings.
So to reiterate, the question, what are the biggest risks to my retirement plan, is a great question for financial advisors. They love it, and because then they can redirect that into answering some other questions on like, well, what do you have set up, and what's your plan? What are your goals in life, and like what are
It
you
helps
doing
us
now?
prepare for the unexpected,
Yeah.
right? And so that way you go into it more confident and saying, hey, look, I've got ABC, all these things that I wasn't thinking about are now, addressed, covered, or we have a plan if something like that were to occur.
All right, awesome. Next question. Is this a question that financial advisors love versus hate? Now, hate's a strong word.
Hate is a strong word. I'm not sure we want to use hate.
It's okay.
Hate's
I just
a
want to
big
hear you
word.
say,
I
gosh,
don't know, some of them.
you get the question. You're like, God, I hate that question.
It's not that I hate it.
Yeah.
It just might not be in our mind
Ideal.
the right question.
Okay. All right. What return can I expect from this investment, Rex?
Nobody can tell what tomorrow's going to bring, right? Yeah. And so because you don't know, you can't predict anything. Nobody can predict anything. We can give you averages. We can give you estimates. We can give you traditionally what different things have done historically. However, at the bottom of every financial advisory firm, at the bottom, it's going to say past results do not indicate future, future performance. And that's very, very true. And so I do think it's important to understand kind of the target rate of return that you're trying to get, what you need to get in order to hit your goals. I think it's important to understand the risk and the reward of the different investments. But if you come in and you're so laser focused just on, am I going to get 10% or 12%, or my neighbor said, I can get 44% in the next year on this thing, right? Whatever ridiculous number somebody might throw out. It's just, it's a guess. Nobody knows. Yeah. And so, we can tell you historically what things have done, but I think, and that's the better question, is where's my target rate of return? What do I need to be shooting for over time, over longer periods of time, in order to reach the goals that I want to reach? And that's a much better question. And what role does this investment play in me getting that? Is this one of the riskier assets that's going to try and bring that rate of return up, although it may increase volatility? Or is this one of the more conservative assets to where I'm accepting a lower rate of return on this asset because I want the stability and the comfort and things like that within the portfolio?
Brandon, what returns am I going to get this year?
It's a good question. It's a good question.
Okay.
But it's usually misunderstood, and I think the misunderstanding is that people want to treat the stock market and the bond market like CDs. Like they want to go in and be like, I'm going to purchase this, and it's going to, return.
No, I'm going to get this.
Right. And a lot of times that's all people have had experience doing. That and there's 401k that they haven't really paid attention to, and so and so it usually that question shows that perhaps there's not as much experience in the market, right? Like if it's a, hey, what from this portfolio long term, what can I expect? Fantastic question, right? Acknowledging that it might drop a lot next year, but that's all right? I understand, and fundamentally, it's an understanding of risk versus the potential risk versus the potential reward, and understanding what risk is in this scenario versus what the reward is. And so once you if you're looking for just a really short answer, what can I expect this year? 12%, right? That's a bad question. But if you're asking, all right, long term as it relates to financial planning and putting all this together, it's a great question.
Okay. All right, it is tax season. So, Brandon, how about the question, how should I be thinking about taxes over my lifetime?
Love that question.
Okay.
Love that question, because that's a question that a lot of times when people work with their tax advisors, like an accountant or CPA, over and over and over, not all of them, but over and over again, I see accountants get so laser focused on the 2026 tax return and how do we minimize taxes this year. And I think that comes because a lot of people judge, and I've seen this, where people judge their accountant based on how big their return is. It's entirely the wrong question, right? Yeah. And I've even talked to accountants who will intentionally tell people to withhold more from their payroll, from their paychecks, in order to boost the return, and they get and keep clients because clients are like, man, my whenever I go to this guy, I get this huge return. Which really, what is a return? It's a 0% loan to the federal government, right? Like it's not that great of a strategy. And yet a lot of times people are so focused on how do I get the most money back from the government this year, and they're not focused on how do I make the most money and pay the least amount of taxes over my lifetime. And sometimes paying the least amount of taxes over your lifetime will end up with a lower return this year.
That is fascinating. That's fascinating because that is a water cooler. Boy, I hate to say I will say low financial IQ brag with someone at the offices are like, well, but my CPA got me this much back. And you're like, right. We all make about the same amount of money.
Sure.
I know that. You know what I mean? I'm like,
right.
It's not necessarily your CPA. You just had more withheld.
Right.
And so how does this, so you're saying the better question would be, how does this affect taxes over my lifetime?
For example, one real life example, for a long time, I would make Roth contributions to my 401k. And then at the end of the year, some 401k plans allow this, I would convert my employer match and I'd convert that over to Roth. Now, when you do that, you have to pay taxes on it, right? And so it would actually reduce my tax return because you can't withhold for taxes because that would be a distribution, right? So I'm just doing a conversion. There's all the flashing lights like, hey, this is irreversible. You're going to owe a bunch of money when you file. But when you do that, you start building up a ton of money in Roth. And long term, I think that strategy is going to play out really, really well for me. But it reduced my tax return in the current year.
Right. Rex?
Yeah, I think there's two elements to this discussion. And I think one is, like Brandon's mentioning, is long-term, what is better for my overall financial health? What's going to increase my net worth the most? And what role does taxes play in that? How much is taxes going to take out today versus 10 years from now or 20 years from now? And I think that's where strategy comes into play. That's, whether we're doing Roth conversions, whether we're doing qualified charitable distributions out of retirement accounts, whatever we're doing. And then I think the other, on the year to year, I think it comes down more to not how much was my return, but my accountant was able to reduce my effective tax rate this year from 21% to 17%. And that's a more accurate measurement as to the effectiveness of the accountants on a year by year basis. Is all things being equal, if if 2025 was the same as 2024 relatively, right? Slight increase in income, whatever the case may be, but yet because of different things that we put in place, we were able to reduce the effective tax rate by 3 percentage points or 4. That's a big deal. Yeah. And that's where your financial advisor and your accountant working together probably came into play to make that happen.
Yeah. Okay. So it's a good question.
That's a
great question.
Great question. All right, Rex, next question. This one is for you. Not personal, but...
Can't we just ask Brandon all the questions and I'll just chime in on different pieces? Can't we do it that way?
We can.
I preloaded the script. Ask Rex this one.
I am 100% asking Rex this question, though.
I'm feeling set up. I'm feeling pre-triggered.
Yep. Should I put my money into gold or crypto?
Oh, my gosh. So,
he's on it already. Instant answer.
So I just received a email this morning from a client that said, my wife really wants to buy silver.
Oh, I was gonna call that for you.
Oh, you were?
Oh, 100%.
Okay.
Right? You can tell what is doing or what has done well over the last 6 months by the emails and phone calls that we get.
Wait, time out.
Absolutely.
The email was, we want to call you over, like to have dinner or something?
Nobody has talked about silver in like decades.
No, ever. But it's been trending.
But you know what? The last 2 weeks, you wouldn't
6
believe the conversations I've had about silver, right?
Yeah.
I mean, and from a logical, just a general investing perspective, right? This is like the easiest, you don't just chase something after it's run up, especially when there's not like something. But man, oh man, it's hard to do emotionally. You see that start to run. And it's not crypto right now; it's silver, and even gold.
Like a Bitcoin, though.
Right. Well, yeah, it's interesting that silver and gold, or everything goes in cycles, is my belief, right? I think most of you know that I believe everything goes in cycles, and right now precious metals are in a hot cycle, right? Gold, silver, platinum, a lot of them have gone up
of life
tremendously.
Song.
And Brandon, yeah, right. What is that?
It's the circle of life.
Yeah.
I mean, because
Lion King.
Yeah, but it applies to all the financial.
It does. It all just kind of goes in circles. And but I do think that Brandon's right. You can almost predict what the next 2 or 3 months worth of phone calls and questions will be during our review meetings, based upon what has been hot for the last 6 months or a year. And also you'll start to see advertisements on TV start to pick up. You'll start to see a lot of advertisements now on gold and silver and buying coins and different things like that. The dollar is weaker right now, which is one of the reasons that precious metals are up. We're coming out of a high inflationary environment from 2022. We're still recouping from that, which again, anytime you run into economic turmoil or downturns, whether it's inflation, whether it's a recession, typically you get people running towards precious metals. And that has happened in spades over the last 6 to 12 months. And I think that people are fearful about the value of the dollar. And I think people are fearful about the economy, and you look at the sentiment out there, and the sentiment is concerned. And so when people are concerned, they move money from banks or CDs or the stock market or different assets into what they view as a more conservative, stable asset. And when that happens, a lot of times you can get bubbles that get created. And I'm not calling a silver bubble or a gold bubble or anything like that.
But I heard a lot of people are going to make money shorting silver.
Yeah, so it'll be interesting to see where it goes, right?
Yeah.
These things typically last longer than what most people think. They typically run further and higher than what most people think. And then when they come down, typically they come down really, really hard and really quick before anybody can prepare. And so I think the right question is, what role does silver, gold, precious metals play in my overall rate of return, my risk profile, and my goals long term? And why am I buying silver? Am I buying it because I think the economy is going to go to zero, the government's going to implode, and we're going back to bartering days to where I can trade silver for cow's milk?
Yeah.
Where are we headed?
Yeah, I think too, right? You just a quick study of history. Tulips in the 1600s was kind of one of the first big crashes where everyone was literally tulips like the flower, right? People were trading flowers and just thought.
When was this?
In the 1600s, I think.
Denmark, in the Dutch had the big tulip
1634
bubble.
through 1637.
There's always a bubble.
But people just dumped their wealth into tulips, right? And why would they do that? Well, because tulips were worth this much this year, now this much this year. Has the value of a tulip really changed? Well, it kind of has because humans want it more, but like underlying that, what is really more special about a tulip today than it was 2 years ago? Like nothing, right? And you can say, and then that happened again with the .com, right? Like what was so special about a website, right? But it's just like humans just get so excited. It happened with Bitcoin, right? It happens with gold, right? And so that's the fundamental difference between investing in companies and owning companies and owning something that is a little bit more fad-like, that is running without. Because, like, for example, people would say last year, man, the S&P 500 grew a ton, like more than average. Does that make sense? Well, when you look at the earnings of the company and the earnings of the company also grew by almost the same amount, then that makes sense. That checks out, right? Like if the company's making, and just easy numbers, right, twice as much money, then the company's stock should be worth twice as much. That's a justifiable difference. But when you have something like gold or crypto or tulips, and all of a sudden it's worth twice as much today as it was yesterday, the question has to be why. Like what is it? And maybe there's a new use for gold, right? Like maybe there's a new use for silver, or maybe there's a new, and so maybe that's driving it and that needs to be taken into account. But if you can't account for the dramatic run up, it's very likely just a bubble.
Rex, but wouldn't you say there's a finite amount of silver and gold and even Bitcoin, and versus an infinite amount of stocks?
So on crypto, I'm not sure there's a finite amount of crypto, right? I mean, it's virtual currency. But is there a finite amount of gold and silver? There is. Do we know what that finite amount is? I don't think we have any idea what that finite amount is. I don't think we're done mining gold and silver.
Right.
I don't think we're done, treasure hunting on the ocean bottom to recover gold and silver that was out there, from pirate ships in the 1500s,
Sure.
right?
Yeah.
And so I think there's a finite amount. Sure. At the end of the day, there's the globe is X big, and there's only so many mountains that you can mine.
But just because it's finite doesn't mean it's valuable. There's a finite amount of tulips. There's a finite amount of a lot of things.
Yeah.
Doesn't mean that it should exponentially grow in cost over 2 or 3 years.
Okay.
Yeah.
So do you like the question or no, Brandon, if someone asks, like, should I invest in gold and crypto?
I mean, I always want clients to ask, right? Like does it do sometimes when it's, because I think if that's something on your mind, you should ask and we should talk about it.
Okay.
And if you really, really want it, we can add it to your portfolio.
Yeah.
But is it really, I don't know. A lot of times there's misplaced expectations, and that's what's driving the question.
Yeah.
You should be open your mind to the complete discussion. Is a lot of times people come in and ask that question and they've already made up their mind.
Oh, gotcha.
They've already come in and they're like, I've got to buy silver because the world's going to end. Or I
bought
gold.
this. Now
right.
You tell me it's okay that I bought it.
Right,
Yeah.
right. Validate my decision.
Right.
And that's not. I think the way we would prefer as advisors for you to come in is ask the question. Absolutely, always ask the questions that you have, but be open to the answers. And the answer is for us to reframe that question of, one, what's the concern? What's the underlying fear? What is it really? Or is it just that your neighbor made a bunch of money in precious metal and you want some of that, right? Just be open and honest about what the issue is. And then be open to the discussion of what role does that really play and what risks does it have at the current level, but what role does that play in what I'm trying to achieve for my retirement? If I'm targeting a 7% long-term rate of return and I'm buying, precious metals at an elevated price, then what are the risks that I can still achieve that 7% rate of return? All of a sudden it goes down to 6.5, 6.25 if the gold and silver component doesn't take on the risk level that we want it to take on. So,
okay, Brandon, next question. And I think I'm just going to go out on a limb. This is a good one. This is a good one. What decisions today will matter 10 to 15 years from now?
I'm loving these question lineup. Yeah, that's a great one. Yeah, I mean that is the superpower of financial planning, right? That is the strength of financial
Literally
planning.
planning.
Yeah, right. Is projecting, because we as humans have such a hard time matching up our decisions we make today with the outcome 10, 15, 30 years from now. And that is by definition, in my opinion, that is what financial planning does, is it allows us to align our decisions today so that it makes sense for us today, as well as 10 years, as well as 30 years. And that doesn't mean that we're just saving all of our money today so we have more money later. And it doesn't mean the opposite, right? It means that we're trying to get a very holistic view of your life and say, how do I maximize the enjoyment with the assets and abilities that I have so that I can enjoy today, make memories with my kids, make memories with my grandkids, make memories with my spouse, whatever it is that you want to do, we can maximize that by, through planning. Now, you can never be perfectly efficient, right? But we can sure get a lot closer by doing those plans. And that's where the math comes in, right? And software, and we can put that together for people.
Rex?
This can be hard to believe, but I had a client call me this week and ask me a question that's kind of pertinent to this. But they asked me the question of, hey, Rex, we're looking at doing some brain health techniques to see if it's going to help us, because my partner is losing some of his memory, and it's getting, we don't think it's dementia, we don't think it's Alzheimer's, but we're definitely seeing a decline in that mental state. And so the facility has brought to us 3 different alternatives that we can pursue. Alternative 1 is X amount and lasts for so long, and 2 and 3 for different amounts. And the question is, this is unexpected. It's a significant amount of money of their net worth that would be put into this, especially if they pick the highest option. And so they're wondering, if we do that, well, how does that set us up if we need long-term care in the future, or if we need, or if we live longer than we expected? How is this going to impact our overall financial health? And I think that is a fantastic question and approach. Now, I can go through and I can say, look, if you spend X, this is how it's going to impact it more likely than not, and Y and Z. That being said, we don't always make decisions for financial reasons. A lot of times we make financial decisions for emotional reasons or health reasons or other reasons. But I think you need to know and should know what the financial ramifications of making those decisions are, because you may have to pivot. If all of a sudden you choose the most expensive option, and whether it's successful or unsuccessful, fantastic, but that may put us in a very different financial position to where we're not able to travel as much, or we're not able to gift as much, or we're not able to achieve these other things that we want to achieve. And if you try and do it all, then your plan's going to implode, and you're going to run out of money well sooner than what you had intended. And so I think that's a fantastic question to be asking, is how is this going to impact me over my lifetime?
Yeah, for sure. Okay, it's a good question. Brandon, my friend invested in this thing, and so should I do the same?
Yeah, I actually do hate that question. And let me tell you why. Okay. On multiple occasions, I have dealt with clients, 401k plan participants, who have literally done this, where we were doing something just crazy risky, but it was working, right? Like getting phenomenal returns. And inevitably what happens is then they're sitting around the water cooler, or they go to their neighbor, and I've seen both of these happen, and they say, man, last year I actually doubled my 401k balance. I actually doubled my IRA with this strategy. And their neighbor says, really? And yeah, I think I figured out this cool, this niche in the system. It's a glitch in the market, right? And
that person's the one. They figured it out.
But I've watched this actually happen, and neighbors say, do it for me, right? And whether it's in a 401k plan, whether
to the friend, not to you.
to the friend,
Yeah.
yeah, and the friend says, help me do it with my IRA or my 401k, and then I've watched them just plummet, and it's devastating, right? And like, if an advisor did that, there'd probably be lawsuits, right? Like, but there, I mean, how do you sue your neighbor for giving investment advice? Like, maybe that's possible. It's a weird place. And the problem is that as humans, I think we often will look at something and we get so fixated on one outcome. Like, this happened last year and I could see how it would happen again. And we like believe that it will happen again. We run it over and over and over in our head so many times that we believe it will happen again. And it's a hard place as a financial advisor to say, hey, it might. Right? Like, and that's hard for me, right? Because I'm looking at them like, yeah, it's possible, but it's also possible you lose all of your money too. And it's kind of a lose-lose, right? Because if they do go do it, and they lose all their money, like that obviously hurts. Or if they go do it and they gain all this money, like, see, I told you, right? But in the end, you almost for sure lose, because then when you do it once, then you do it a second time and a third time and multiple times. I've watched this where you grow, and it just plummets and you lose it. And so, I mean, it depends on the strategy, right? And some strategies are dramatically more risky than others. But I've seen this over and over, because what is the number one builder of wealth? It's concentration. What is the number one destroyer of wealth? It's concentration. And people find this concentration and even loopholes on concentration.
I've heard that somewhere.
Like options contracts and other things that enable them to get so deep into concentration that they're either going to retire with tons of money or they're going to lose it all. And I don't know why, but gambling is a really addictive thing for the human brain, as is illustrated by Las Vegas, right? Like, and it's a weakness that we have because we're not perceiving. That's one area we don't perceive the risks, and we're so fixated on the return that it often will end very poorly.
Well, definitely passionate about that answer. Brandon, Rex, what about you?
Yeah, I feel the same as Brandon. It's a difficult question. I think it's fine. Again, ask your questions. Absolutely ask your questions. But we need to ask again, is it worth, taking the risks to pursue that strategy in light of what may happen? And are you aware of the risks? And most of the time they're not aware of the risks. They feel like it's a risk-free adventure that they're about to go on, that this could never lose.
What if, Rex, the friend says, I just found this awesome new financial planner at planwithbaxter.com. You should do the same.
I think there's a big difference between finding fantastic, fabulous people that can give great advice, versus put it all on red.
Yeah. Okay.
So I think there's two differences there.
Okay. Fair. Brandon, I think we need some more numbers.
Oh yeah,
this
we do.
time. So yeah, before we dive into the next love versus hate question, which again covers retirement, we need some more numbers.
So it is unreal to look at how much we are launching into space today, primarily because of Elon Musk and SpaceX, right? But this stat is just mind blowing. The total number of objects launched into orbit since 2022 exceeds the combined total from 1957 through 2021.
Wow. Yeah.
In 3 years, we launched more into space than over, how many decades is that? 5 decades?
What's Musk's satellite system?
Starlink.
I remember the first time I saw it. I was.
Me too.
What the hell?
I was in the
going on?
Uintas.
Yeah.
I saw it go by. I was like, aliens! Like, this is it. Like, this is not real.
100%. I was in my own backyard. I'm like, they're coming for us. Like, and then I learned somehow. I think I searched it. Like, what is going on?
Yeah.
And then it's Starlink.
Yeah.
That's crazy.
Interesting. Does it say how many, out of curiosity?
Oh, I might be
Like how much is it? And
Starlink has 9,300 star satellites in low Earth orbit.
Interesting.
But I think I've got the.
I mean, it's interesting. People are like, "Oh my gosh, space is getting so crowded," and it's like
space, dude.
You think
And
about
it expands
you think
every
about
year.
9,300, and it's like, okay, in our little city of Ogden, do we have more than 9,300 cars?
And, and
Way more than that.
space is expanding. So we were talking about infinite versus
Yeah.
Good luck, dude.
Yeah. I don't feel like space is getting crowded.
No.
Yet.
Yeah. I mean, we were in the low hundreds of launches into space up and through like 2012, like almost nothing. Now we're launching 3,000 to 4,000 a year
That's crazy.
into space.
Yeah, that's a lot of launches.
Yeah.
But it's still, I mean, there's so much space in space.
Is there a finite amount of space? Infinite?
We don't know.
But are there like what in what investments is a category like what funds are those, like the space funds or whatever? Because that, I mean, obviously it's blowing up.
Yeah, there's certainly different kinds of funds that invest in the technology that goes into satellites and goes into propulsion and goes into the aerodynamics of a rocket or something getting launched into space. And so there's certainly
Rocket
some
parts.
ETFs and different things like that I'm not going to name specific names on our podcast, but there's definitely pieces that if you believe in a micro sector such as that you could look at for a risky part of your portfolio.
Okay.
It's also interesting. The U.S. is launching 87% of all global launches in 2025. Second place, China.
Yeah.
At 6%.
Yeah. Wow.
87 to 6.
Yeah.
Wow, that's a big difference.
All right, we got 4 questions left for the advisors' love versus hate. The next one, Rex. How will our strategy change once I retire?
Great question.
Great question.
Love that question.
Okay.
And so we talk, I think it shows an aptitude for the understanding of, okay, I've been in this accumulation phase since I started working to accumulate these dollars, and that's a very different investment mindset than a distribution phase, to where, okay, now I've got all these dollars that we've invested and saved. Now, how do I coordinate them in order to pull them out and live on them and not blow up my tax situation and try and minimize my tax? And you look at all these different aspects. I want to maintain liquidity. I want to minimize taxes. I still want to maintain a certain growth rate. And yet at the same time, I'm pulling funds out. And so I think it's a great question to be going through to make sure that your advisor is good at both aspects. And some advisors are great at both aspects. Some advisors are a little stronger during the accumulation phase. Some advisors are a little stronger just during the distribution phase. And so I think you want to make sure you have a good, well-rounded advisor in that aspect.
Yeah, and it's a fun conversation to have, right? Because sometimes people think that once I retire, I put it all in cash and I just start my scheduled distributions all the way out, right? And that's not usually the case, and almost never, right? Just because once you start, even day one of retirement, there's money you won't need for 10, 20, 30 years. And so if we've got time frame, it usually makes sense to invest it.
Okay. All right, next question, Brandon. This is for you. Should I?
Yeah, you load these up with so much anticipation. It's awesome.
I just want to know. I mean, it's a little crazy right now. Should I move things into cash until things calm down?
Yeah, I hate that question. Again, if you're thinking it, you should ask it, right? But if you're thinking it, it also means you're probably not in the right investment mindset.
Okay.
And so it's good that it's asked, right? And I'm glad people ask, because we need to work through that. But if you're of the mindset that, hey, I'm going to try and pull in and out of the market and try to figure out like time this perfectly, like it's a losing strategy, as has been proven over and over and over and over.
Well, it doesn't help that I like Stu Varney on Fox Business. I watch him, and he basically asks people if they are buying this thing today because of a certain thing happens in the world, right? And he's like, because of this or a certain company or whatever, and then he asks the guests, like, so are you buying? What are you doing?
But that's a different question, right? Like if the question is, hey, Brandon, hey, Rex, where are we moving? Where are we tilting the portfolio? Are we moving more internationally, less internationally? Are we getting into different sectors? What stock did we add or sell, right? Like that's a different question. But the question, should I move everything into cash until things calm down, means I'm panicky,
Oh,
right?
gotcha. Okay.
And when we get panicky, we make the wrong decisions. And again, and I sound like a broken record, but that's why humans aren't good at investing, in my opinion, is because our guts are so good at reading most situations. We can like talk to someone and gauge how they feel. We can gauge if we can trust. We can gauge all these things. We're really good at our guts, just something inside of us. That is not true of investing 99 times out of 100, it seems, right? That people's natural inclination is almost always wrong. When stock prices are down and people are nervous, that's when people want to sell. And then once they've run a long time and they're really, really expensive and people are all overly excited about everything going on, that's when we want to buy, right? Literally, it should be the inverse. And yet that's not typically what humans want to do. And so when someone asks, should I move everything into cash until things calm down? Usually I'm getting that question when markets have fallen quite a bit. And the odds of future performance over the next year or two are way higher. And then they're probably not going to want to get back in until the markets come back up. And it's just I've got a few clients that do this, right, over and over. And I think we've gotten through with most of them, right, to where we're not in and out. But that's what I've told them. I'm like, guys, if we keep selling when things get bad and buying once things settle down, your net rate of return is going to be horrible, right? We're not going to be able to hit your financial goals because we're just doing the wrong thing at the wrong time, always based on guts. And so that's why I really don't like that question.
Rex?
I think it's a tough question. And because I think that, again, people are looking for validation that the market's down. I've already made up my mind that I want to get out of the market because this was painful. And it does come down to the fact that they've taken too much risk because they can't stomach that downturn. And so whoever you're working with has probably set up your portfolio to be more aggressive, or that you're not reviewing it frequently enough. And so as the market skyrocketed, you didn't get rebalanced and take money and get it appropriately diversified again back into your risk profile. But then it's difficult because when somebody makes that decision, then you've got two more decisions that you have to get accurate. And so essentially, when you ask that question, you're asking, can I get perfectly correct 3 decisions? Is today the right day to get out? What day is the right day to get back in? And what do I get into on that day that I get back in? And if you can't nail those 3 questions every single time, then you're going to be wrong, and it's going to be painful. It's going to be a very painful lesson. And I don't know anybody that's going to get those 3 questions right more than they're going to get those 3 questions wrong. And so, our advice is, if you're feeling that way, absolutely ask the question, because it means that we probably are taking more risk than you can handle in your portfolio. And so let's look at that. And as the market recovers, after the market has recovered, then let's readjust the portfolio back into the right risk profile. The difficult thing is once that market has come up, most people feel really, really good. And they're like, oh, no, now I've made all this money. I don't want to get more conservative now because the market's so hot and doing so well. And so then they change their mind and they don't want to get until the next reminder. But once they've gone through a cycle or two of that, and we consistently are pointing that out of, remember last time you called me and it was right close to the market bottom, and then we talked right near the market top, and we wanted to get more conservative at that point to kind of match your risk profile. You didn't want to do that. Now we're near the market bottom again, more likely than not, and now you want to get out again. Are you seeing that pattern in yourself? And so as we continue to work with people and educate them, then that tends to work itself out over time. The problem is when we very first meet with a client, if we're meeting with them at a market top and they just bring the money into us, and we're just getting to know you, and so we're just setting up that risk profile, and all of a sudden we get into a downturn, then that's really frustrating for people. And so that's really challenging. But I think you just need to make sure you're listening to your advisor and walking through. But if you are feeling that way, absolutely ask the question. I actually, like the question being asked. I just want to be able to reframe it, and I want to make sure that you have an open mind as to understanding why am I asking the question and what do we need to do so that next market downturn we don't have that same question.
All right, Rex, the next question to love or hate is, you're my financial advisor. How do I define if you are being a successful financial advisor, if not just based on the returns I'm getting?
Well, it should be based on your goals. It should be based on are we
My goal is to get the biggest return on my money.
is it? Is
So
that your goal?
That's not usually that you would think.
Yeah.
Your goal should be to be able to spend the most amount of money consistently throughout your life. Probably, right? Like, I'm not telling you what your goal has to be, but for most people, the goal is not to see a highest percentage, because we can get you the highest percentage by just throwing it in aggressive stuff. But then if you're in retirement taking distributions, you're going to cut into that. Like if you go through a recession, which you likely will over a 30-year retirement, you're going to cut so deeply into that return as you're taking out twice as much when the market's down, that you end up spending less and getting less money in retirement. It's not about just the straight dollar percent. It's about getting a good return while also being prepared for the downturns that inevitably will likely happen.
I think it's looking at risk-adjusted returns, which is what Brandon's talking about. Is if you are a moderate investor, then you may have, let's say, 60% of your money exposed to the market. And if you have 60% exposed to the market and the market does 10%, then we would anticipate that part of the market, that part of your portfolio does 10%. Mm-hmm. However, it's only 60%, right? And so that means that you got a 6% rate of return, and then you have the more conservative money that maybe did 5%. And so that gives us another 2. And so you may get 8%. Man, that's a lot of numbers for a podcast. you may get 8% when the overall market's getting 10, but risk adjusted, that's fantastic. That's right in line with what you should be expecting based upon your risk level that you're comfortable taking. And then on top of that, is your advisor helping you to coordinate the minimization of taxes? Are they helping you to check the other estate planning boxes? Are they helping you, discuss the legacy planning that you want to do with your family? And so is the advisor covering these other areas? Are they making sure that you have liquidity that you need when you need it? Other than just return. It's not just a game of return, although that is important, and I don't want to minimize that. Return is important, but it's not the only part of the equation.
Yeah. Okay.
And we talk about rate of return on portfolios in probably every meeting we have with a client. Even if we have other things we want to talk, like I'm always talking about where's our return, where are we at, what did we do? Because it's very important that you know what your real return is and where you're at. But it's not the only thing we talk about.
Okay. Well, Brandon, I have one last question for you. Is now a good time to invest?
Yes, it's a great question. It is a great time to invest. But the reason a lot of times we hate that question is because, again, it insinuates that perhaps we're not thinking about, we're not in the right frame of mind to be investing. Because when someone asks, is now a good time to invest, it also means, hey, but there's going to be other times that I don't want to be invested in at all, right? And it kind of goes back to that timing the markets game. I remember way back when I was getting my degree from the great Utah State, one of my finance professors said, put up a chart, right, of the market over time. He said, all right, where is the right time to be buying, and when is the right time to, and all of us like, oh, down at the little troughs at the bottom. And he's like, no, you are buying here and here and here, and it's consistently along the way. And that's
a trick professor question.
It was, but it stuck with me.
They don't do that.
Yeah.
It's important to fundamentally understand markets and equity ownership. And if we're thinking about getting in and out, it usually, makes us think that maybe we're not thinking properly about it.
Okay. Right.
I think it's a natural question for people to ask when they receive a lump sum of money. If you receive an inheritance, if you sell an investment property, something like that, I think that's a very natural question to ask is where should I deploy these dollars next? Is it a great time to invest in the markets? Is it not? Should I put it in cash or CDs, or should I put it into other real estate or silver and gold and crypto or whatever, right? And so I think that's a very natural question. Careful.
Okay.
Unless you're going to say
well-balanced portfolio.
Banyan Collective or something.
Planwithbaxter.com.
Yeah. So
we don't have our own stock yet. So
it's more of a charitable gift.
Right, yeah. But you can still go to buymeacoffee.com/Banyan and
Yeah, I think regarding, is today a good day to invest? Is it a good time? I think, the consistency is key. If, that's why 401ks are fantastic, because it comes out of every payroll and every pay period, and you buy whether the market's up or down or anything else. But when you're receiving a lump sum, I think you're always going to second guess yourself. You're always going to look back, 6 months from now, a year from now, and say, gosh, if I had only waited, or gosh, I'm glad I put it all in, at the beginning. And I think that's a natural thing. And so sometimes people will dollar cost average, and they'll put in, I'll put in 10% a month for the next, 10 months, or I'll put in a quarter now, a quarter in 3 months, a quarter in another 3 months, and so forth. Studies show that it's best to put it in when you have it. And so when you first receive it, just put it in, let it work, and go. The reason studies show that is because the market goes up more than it goes down.
Yep.
That goes against the old dollar cost averaging.
It does.
Thing.
Yeah. But it mathematically works. Now, why does dollar cost averaging make sense? Well, because most of us are in a 401k, and we're adding month after month after month.
Paid monthly.
And it's cool because the average purchase price is lower than the average price, right? And there's math on how that works. But so we all hear dollar cost averaging, think it's magic, and we love it. But Rex is right. Statistically, if you have a big lump sum of money, if you put it in all at once, the majority of the time you're going to end with more money than had you dollar cost average that in. Now, that doesn't mean that it's emotionally easy to do, right? And I'll have this conversation with clients like, hey, even though that's statistically the right answer, it can hurt to throw this huge sum in and have markets drop, especially if we're in a time of volatility. And so sometimes we'll spread that out, even if it doesn't make scientific statistical sense. It's more emotional. But that's a good conversation to have with your advisor and decide what's right for you.
Yeah.
All right. Very good. Well, those are good questions. All of them were good questions to ask your financial advisor at planwithbaxter.com. You should check them out. This podcast was produced by the Banyan Collective and recorded in our camp trailer studio right here, located inside the Monarch Building, inside the 9 Rails Arts District on historic 25th Street in Ogden, Utah. How about that? Now you know exactly where we are. You can come haunt us. If you found value in this podcast, again, I suggested this earlier, you should just give all your retirement to buymeacoffee.com/Banyan Media. This is not endorsed by planwithbaxter.com. In fact, they would advise you against that. But you can give us like $5 or something. Anyway, chip into the podcast, buymeacoffee.com/Banyan Media. It would mean the world to us. You can watch and subscribe to us on YouTube at Through the Pines. You can like our Facebook page as well, Pines Podcast, and we're even on Instagram. You put up little shorts of the program, so you can check on those and be reminded of what we talked about, and that is at Pines_podcast. Again, it's been Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.